On the EA exam, rollover questions are really spot the trap questions. A direct rollover, also called trustee to trustee, means the money never touches your hands. That's the cleanest option because it avoids withholding and timing problems. An indirect rollover means you receive the money first, and now you're on a clock and subject to extra limits. With an indirect rollover, two rules matter. First, the 60-day deadline, redeposit the distribution within 60 days or it's taxable and possibly hit with the 10% early penalty. Second, the once per 12-month rule for IRA to IRA indirect rollovers. Trustee to trustee transfers are not limited, and Roth conversions aren't limited either. Here's the nasty part of indirect rollovers from employer plans like a 401k. Mandatory 20% federal withholding. Even if you plan to roll over everything, the plan will still withhold. To make the rollover fully non-taxable, you must replace that withheld 20% with your own cash when you redeposit. The withholding becomes a tax credit on the return. Don't confuse a rollover with a qualified disaster distribution repayment. A qualified disaster distribution can be repaid for up to 3 years from the distribution date, and the repayment is treated like a rollover. That's a special rule, and it's reported on Form 8915F. On the exam, the giveaway is the 3-year recontribution window. Next trap, excess IRA contributions. If you contribute more than allowed because of the annual limit or because you lacked enough qualifying compensation, the excess is subject to a 6% excise tax. The fix is to withdraw the excess plus related earnings by the return due date, including extensions. If corrected on time, the 6% applies only to the earnings, and it's reported on Form 5329. Inherited IRAs changed under the Secure Act. For most beneficiaries, the stretch is gone and the account must be emptied by the end of the 10th year after the year of death. But eligible designated beneficiaries get special treatment: a surviving spouse, disabled or chronically ill, a minor child of the owner, or someone not more than 10 years younger. Spouses have the most flexibility, including treating it as their own. Finally, prohibited transactions and prohibited investments can blow up an IRA. Think self-dealing. Using IRA assets for personal benefit, like buying a vacation property and letting family use it, can disqualify the IRA. If a prohibited transaction happens, the account is treated as fully distributed on the first day of the year. Also, watch prohibited investments. Collectibles, life insurance, and S-Corp stock are classic exam favorites. Marisol has a traditional IRA, and she's also covered by a 401k at work. Because of that, she's made several non-deductible contributions to her IRA over the years. How does Marisol calculate the basis in her traditional IRA? The choices include no basis at all, basis as deductible plus non-deductible contributions, or basis as non-deductible contributions adjusted for distributions. Think about it. The correct answer is that basis equals non-deductible contributions minus any distributions that already recovered that basis. That's why Form 8606 matters. It tracks cumulative non-deductible amounts and how much has been used up through prior distributions or conversions. A tempting wrong answer is adding distributions, but distributions generally reduce remaining basis once it's been recovered tax-free. Ethan turned 72 on July 30th, 2023. He's still employed full-time and he has a Roth IRA. When must he start taking required minimum distributions from his Roth IRA account? The options include dates like December 31st, April 1st, or never. Think about it. The correct answer is never. Roth IRAs are not subject to required minimum distributions during the owner's lifetime. The age rules you're thinking of apply to traditional IRAs and many employer plans, but not to an owner's Roth IRA. The tempting wrong answers are the usual RMD deadlines, but they simply don't apply here.